probably seen a headline about it, something about pensions and inheritance tax. Maybe you scrolled past it. Maybe it made you vaguely uneasy and told yourself, I'll look into it later. This is later. Because from April 2027, the way pensions are treated for inheritance tax in the UK is changing. And most people, including a lot of people who consider themselves reasonably on top of their finances, don't actually understand what that means for them. Not because they're not paying attention, but because most of the coverage has been either a 2-paragraph news story that doesn't explain anything, or a 40-minute financial planning seminar that loses you by minute 3. This video is neither of those things. By the end of it, you'll understand exactly what's changing, why it matters, and whether you need to do anything about it. That's it, no filler, let's go. Welcome to Money Under the Microscope, where we make finance clear. Now, let's put pensions and inheritance tax after April 2027 under the microscope. What inheritance tax actually is. Okay, before we get to the pensions bit, let's make sure we're all starting from the same place. Inheritance tax is a tax on what you leave behind when you die. In the UK, the starting rate is 40%. It applies to everything in your estate above the tax-free threshold, which for most people is £325,000, sometimes higher depending on your situation. So, if you die with an estate worth £600,000 and your threshold is £325,000, the taxable portion is £275,000. At 40%, that's £110,000 going to HMRC before your family even sees it. Now, for most of UK history, your pension pot was not included in that calculation. It sat outside your estate, which meant that if you had £300,000 in a savings and investment and £300,000 in a pension, the pension wasn't counted. Your estate for inheritance tax purposes was just a £300,000. That was incredibly useful, and an enormous amount of planning built around it. People structured their entire retirement strategy around that one fact. What's actually changing? From the 6th of April 2027, most unused pension funds are expected to be brought into scope for inheritance tax. What that means in plain English is, if you die with money still sitting in your pension, money you haven't taken out and spent, that money may now be counted as part of your estate. And if your estate is above the inheritance tax threshold, that pension pot could now be taxed. There are some things that are expected to remain outside of scope. Death in service benefits from registered pension schemes, which is the lump sum your employer pays if you die while you're still working. However, the pension pot itself, the one you've been building up over your working life and haven't touched, that's in the firing line. Now, let's be clear about something. This is not the government stealing your pension. You can still access it. You can still draw income from it. The tax advantages during your lifetime don't disappear. What changes is what happens to whatever is left when you die. Previously, leaving a large pension pot untouched was one of the most efficient things you could do for your family. The money sat outside the estate. It passed to your beneficiaries cleanly, and everyone was better off. After April 2027, that logic no longer applies automatically. A large untouched pension pot may now add to your inheritance tax bill in exactly the same way that a large savings account would. Who this actually affects? Here's the question most people ask at this point. Does it affect me? And the honest answer is, if you have a pension, you should at minimum understand what's changing. Even if it turns out the answer is that it doesn't significantly affect your situation, that's still worth knowing. Let's think about it practically. The inheritance tax threshold for a single person is £325,000. There's an additional residence nil rate band of up to £175,000 if you're passing a family home to a direct descendant. For a married couple or civil partners, those thresholds can be combined. So for many families, the threshold before inheritance tax kicks in is somewhere between £325,000 and £1 million depending on the specifics. Now, add your pension to that picture. Someone with a modest pension of £150,000, a paid off house worth £350,000, and some savings may currently sit comfortably under the threshold. But if the pension was previously outside the estate and is now inside it, that calculation shifts. Someone with a larger pension may now find that strategy needs completely rethinking. And here's the thing about pension pots in the UK. They've been growing. Years of auto-enrollment, employer contributions, and tax relief on contributions have meant that millions of people, ordinary working people, not just the wealthy, are sitting on pension pots that are larger than they realize. This is not a tax on the rich. It's a change that could affect a lot of ordinary families who haven't thought of themselves as having an inheritance tax problem. Why the old planning logic breaks down. To understand why this matters, you need to understand how pension planning worked for a lot of people before this change. The logic was simple. If you had multiple pots of money, you tried to spend in a specific order. Cash first, then ISAs, then other investments, and the pension, you left that for as long as possible. Why? Because the pension sat outside of the estate. Every year you left it untouched, you were potentially saving your family 40% on that money when you died. It was often described as the most tax-efficient pot to leave behind. Financial advisors built retirement income strategies around it. Families planned around it. That thinking now needs reviewing. Not because pensions are suddenly bad. They're not. Tax relief on contributions, employer contributions, salary sacrifice, the ability to build retirement income, all of that still exists and it still matters. But the specific reason many people chose to leave their pension until last, that it sat outside the estate, is now weaker. Which means if your retirement income plan was built on that logic, it's worth asking whether it still holds. And the answer for many people is that it needs at least a fresh look. What you shouldn't do. Before we wrap up, a quick word on what not to do with this information. Don't panic. Don't watch this video and immediately call your pension provider and tell them you want to take everything out. That could create a significant income tax bill and leave you worse off than the inheritance tax would have done in the first place. Don't assume the answer is obvious, because it isn't. Someone with a £150,000 pension and a modest estate is in a completely different position to someone, say, with a £700,000 pension, a mortgage-free home, and adult children. Same rule change, completely different planning answer. And don't assume this doesn't apply to you without actually checking first. The people most affected by this change are often the ones who plan the most carefully under the old rules, because they're the ones with the largest untouched pension pots. So here's where we are. From April 2027, most unused pension funds are expected to be brought into scope for inheritance tax in the UK. The exemption that allowed people to leave pension money outside of their estate and that shaped retirement planning for a generation is going away. That doesn't mean pensions are bad. It doesn't mean you need to empty your pension. And it doesn't mean every family is suddenly facing an inheritance tax bill. What it means is that pension strategies built around the old rules need to be looked at again. Some will still make sense. Some will need adjusting. And a few will need a significant rethink. The question isn't whether the change is good or bad. The question is whether your pension plan was built for a set of rules that no longer exist. In the next video, we're going to get specific. 5 pension habits that used to be smart and why each one might need reviewing after 2027. If you found this video useful, don't forget to like, share and subscribe to see more videos from Money Under the Microscope. Plain English, no waffle, and the stuff that actually matters.